In 1817, the New York Stock Exchange was a room above a fruit stand on Wall Street. 24 men traded 5 stocks. That is it. Today, that same idea moves more money in 1 second than those men saw in their entire lifetimes combined. And yet, most people who put their money into stocks still lose. Not because the market is rigged, because almost nobody understands what they're actually buying. Let's start with a question that sounds simple, but almost nobody can answer correctly. When you buy a share of Apple, what do you actually own? Most people say a piece of the company. That is technically true, but it explains nothing. You do not get a corner office. You do not get a vote that matters. You do not get to walk into an Apple store and take a phone home for free. What you actually own is a claim, a tiny legal claim on the future profits of a company you will never meet the CEO of, run by people who make decisions you will never see, based on information you will never fully have access to. That gap between what people think they own and what they actually own is where almost every stock market myth is born. Here's why this matters right now more than it did 10 years ago. In 2010, roughly half of American households owned stocks. By 2024, that number crossed 62%. Apps made investing feel like a game. A few taps and you own a piece of Tesla. A few more and you're in Nvidia. The friction that used to stop ordinary people from entering the market is gone, but the education never caught up to the access. Millions of people now own an asset class they were never taught to understand. So let's actually understand it properly from the ground up. A stock exists because a company needs money and does not want to borrow it. If a company borrows money, it has to pay it back with interest on a schedule, no matter what happens to the business. That's risky. So instead, some companies sell small pieces of ownership to the public. In exchange for your money today, you get a claim on whatever the company earns in the future. If the company does well, that claim becomes more valuable. If it does badly, that claim can become worth nothing. You're not lending, you're betting with legal paperwork. This is where the first uncomfortable truth shows up. A stock price is not a measurement of what a company is worth today. It is a prediction of what people believe it will be worth years from now, updated every single second by millions of strangers who mostly do not know each other and mostly do not agree. Think about what that actually means. When Tesla's stock moves 8% in a single day, nothing about the car has changed. No factory burned down, no new engine was invented. What changed is the story. Someone tweeted something. An earnings call used a slightly more confident tone. A single analyst changed a number in a spreadsheet, and billions of dollars moved based on updated collective imagination. This is the part most people never get taught. The stock market is not primarily a reflection of the economy. It is a reflection of expectations about the economy. And expectations move faster, harder, and far more emotionally than reality ever does. Now here is where it gets interesting and slightly uncomfortable. If you ask most new investors why a stock goes up, they will say something like, because the company is doing well. That is the story sold to beginners. Buy good companies, hold them, get rich slowly. It is not wrong, but it is incomplete in a way that costs people money. A company can report record profits, and its stock can fall the same day. This happens constantly, and it confuses almost everyone the first time they see it. The reason is simple once you see it. The stock price already had expectations baked into it before the earnings report came out. If the company was expected to make $10 billion and it made $9.5 billion, that is still an incredible result by almost any normal standard. But the market does not grade on being good. It grades on being better than expected. Miss the expectation, even while making more money than ever before, and the stock gets punished. This is the first hidden mechanism nobody explains clearly.
You are not investing in company performance. You are investing in the gap between performance and expectation. And expectation is set by professionals who spend 60 hours a week doing nothing else, competing against people who spend 20 minutes reading a headline before buying. Which brings us to the myth versus the reality. The myth, the one sold in every beginner course and every motivational post, is that stocks are how ordinary people build wealth by simply believing in good companies. Buy Apple. Buy Amazon. Hold forever. Get rich. The reality is messier. Roughly the majority of individual investors underperform the market average over long periods, not because they pick bad companies, but because of timing. They buy when excitement is high, which is usually near a peak. They panic and sell when prices fall, which is usually near a bottom. Then they wait for confidence to return before buying again, which means buying back in higher than where they sold. This cycle, repeated across millions of people, transfers enormous amounts of wealth from impatient, emotional money into the hands of patient, unemotional money. Here is the quiet, almost darkly funny part of all this. The single most reliable strategy in stock market history, buying a broad index and holding it for decades without touching it, requires no genius, no special information, and no talent. It requires only patience and boredom. And yet, it is the hardest strategy in the world to actually follow, because doing nothing while headlines scream at you every single day feels unbearable to most human beings. The market does not really punish stupidity. It punishes impatience wearing the costume of action. Now let's zoom out, because this is bigger than picking stocks. The stock market has become something close to an emotional nervous system of the modern economy. When it falls sharply, consumer confidence drops within days, even for people who own no stocks at all, because news coverage frames falling markets as economic danger. When it rises, spending increases, even among people who never check their portfolio, because a rising market creates a background feeling that things are fine. The market shapes psychology, and psychology shapes real economic behavior, which then shapes the market again. It's a loop, not a straight line. This creates a real risk most people never think about. As more retirement money, pension money, and everyday savings get pushed into stocks by default, whole economies become more sensitive to market mood swings than ever before. A market correction is no longer just a financial event. It ripples into consumer spending, corporate hiring, and government tax revenue, because so much of modern life is now financially wired into the performance of the stock market. So here is where this leaves us. Stocks are not a shortcut to being rich. They're a slow transfer system, moving wealth from people who react emotionally to people who wait patiently, wrapped inside a market that runs on prediction more than on truth. The people who actually build wealth through stocks are rarely the ones who understand companies best. They are the ones who understand their own impatience best and build systems to protect themselves from it. Which leaves an uncomfortable question worth sitting with. If the market rewards patience over intelligence, and most of us were taught to chase intelligence instead of building patience, then what exactly are we being trained for when we start investing? Getting rich, or simply learning, slowly and expensively, how little control we actually have?